Hi, everybody. Chris Englebert with Englebert Financial Advisors in Allentown, Pennsylvania. And this is the first of the month update, and it's February already, 2026. Can you believe it? Well, what's on everybody's mind right now? I always start out with a cartoon, and guess what? Unfortunately, Puxatawny Phil on Monday saw his shadow, which means 6 more weeks of winter. And we're based in Pennsylvania, and this has been a brutal winter in Pennsylvania with lows at night at 0 to 5 and highs during the day of 15 to 20. It reminds me of my days living in Minnesota. But what's been going on in the financial markets? Let's start out with the S&P 500. January was another positive month, believe it or not. We'd literally had 7 months in a row. December was down slightly. Now January's up. Let's see what that happens in February. So far as I'm doing this video, February is actually down about 0.5%. But the real story this year is there's some big underlying changes going on in the indices. And February is a big month for us here at Englebert Financial Advisors because we changed a lot of our portfolios to reflect our thinking for 2026, which I'm going to cover at the end of this video. But the big news so far is that the Russell 2000, which is a proxy for small mid-cap stocks, has really been the best performer this year. It's up over 5.5%. Now, we don't really invest in the Russell 2000. We use some actively managed small mid-cap ETFs, and those have done extremely well so far out of the box. We think that there's a big tailwind behind small mid-cap stocks. We think what's going to happen is that the tech area is going to provide some challenges because of valuations for 2026. And the areas that we've been talking about for about the last 8 to 12 months are really starting to turn on. Dividend stocks have had a good year, i.e. value stocks, and also small mid caps. So the big change that we saw in our portfolios this year was the rotation out of any type of growth as measured by the Vanguard VUG, moving into the VTV, which is the value, emphasizing international. We have a larger weighting in international going into February, and our biggest weighting is in the small mid-cap value, mid-cap growth area that we think is going to be a big winner for 2026. So let's talk about the dangers of parabolic markets. Now, we see this all the time. We have clients calling in. A couple of years ago, it was Bitcoin. Why aren't we in Bitcoin? And Bitcoin was going straight up, just like an F-16 going vertical off the end of a runway. Same thing happened with gold earlier this year. Gold started to really levitate. And in the last couple of weeks, gold has gone from 3,000 an ounce to 4,000 an ounce to 5,000 an ounce. And a lot of people are saying, why am I not in this particular asset class? And we say, because there's a tremendous amount of danger. And I just said this to a client last week that, you could wake up one day and have gold down $1,000 an ounce in a couple of days. Sure enough, this week, that's exactly what happened. Parabolic markets are extremely dangerous. And what we tell people, whether it's a stock, whether it's a stock indice, whether it's a commodity, and oh yeah, by the way, back in the 1980s, we traded a lot of commodities. We've seen parabolic markets in corn, soybeans, crude oil, etc. The only way to manage a parabolic market is to have some kind of profit discipline where when you get X% of profit, you take some money off the table. Because what happens with a parabolic market, just like you see it spikes up, it also spikes down as well. So this is the danger of a parabolic market. The precious metals are in parabolic markets. Parabolic markets tend not to end well. And that's one of the things that we've been trying to warn people about as far as what's going on is in the precious metals. So I wanted to recap some of our major themes and let you know how they're working out so far after the first month of January. Bear with me if you've seen this before in my previous videos. But again, we think in the fixed income space, we have the yield curve returns to normal. What we mean by that is that short-term interest rates start to come down. Now, obviously, we don't think really that's going to happen until probably the second quarter of 2026. There was a Fed meeting. They did not lower interest rates, but we think eventually by Q3, Q4, you're going to see short-term interest rates coming down. We just bought some 3-month CDs at 3.75%. We buy them through Schwab. Schwab puts out about 100 different banks. So you can still get 375 on a 3-month CD, but we think by later this summer, it's going to be close to the 3% range. We think on the long end, as far as interest rates, they hold steady where they are, and that fixed income is obviously now a viable option. If you want to take risk off the table and not have as much in equities, you can now buy bonds and get some decent, attractive yields. Again, we think the equity markets return to normal. This is playing out through the month of January and so far into February. And what we mean by that is the Mag 7 is underperforming the rest of the markets. We think you have to diversify your equity exposure. We think that, dividend stocks, i.e. value, are the place to be, and they've started off the year very strong. As of this recording, the Dow Jones Industrial Average is almost making a new high or about to make a new high. So think about the Dow Jones DJIA as a proxy for value and dividend stocks. It does have some technology stocks in it, but it's more of a proxy for value dividend stocks. And think of the NASDAQ, the QQQ, as the proxy for large cap growth stocks. And what we're saying this year is that there could be a large reversal between value and growth, because growth is extremely stretched, obviously, on a valuation basis. And finally, again, like we started out the video, small mid-cap stocks. There have been years in the past where when small mid-cap stocks start to outperform, they really outperform the averages. We think, again, there's several tailwinds behind small mid-cap stocks that people are not considering, and we think that could be one of the biggest winning asset classes for the year. However, having said that, we do think that there's a choppy, higher volatile market between now and the midterm elections. If you look at some of the charts from some of the stock indices during midterm elections, they tend to chop around until the middle of summer. They begin to firm up. And then as we get closer to the elections, you begin to see a better price action. So it would not surprise us that between February and July of this year, we chop back and forth, especially on the S&P 500 and the NASDAQ. Sometime August, September, we make some type of low. I don't know how low that's going to be. And then we firm up going to the third and fourth quarter as people realize what's going on with the midterm election. So again, that's our first of the month update for February. Again, if you want this kind of information, this video is obviously being sent to you, but you can also download my app by texting Chris E, that's CHRISE, to 36260. If you're a client, it's a great way to access your Schwab account. If you're a 401k or 457 participant, we have a page on there where you can access either through RPG or K-Trade and see what's going on as far as your 401k and 457 goes. So that's February 1st of the month update. We'll be back next month. We'll talk to you soon.